The internal economics of cryptocurrency infrastructure market has undergone a massive shift. For over a decade, the business model for public Bitcoin mining firms was very simple. Secure cheap electricity, buy specialized computers, and hold onto the mine tokens until a bull market arrived. However, in mid-2026, the pure mining business model is hitting an economic wall. Following a major drop from the previous all-time highs of late 2025, pure-play crypto miners are suddenly losing thousands of dollars on every single token they produce. To survive, a growing cohort of listed miners giant is executing a radical transition, remaking themselves into high-performance computing centers for artificial intelligence companies. Today, we are going to break down this infrastructure pivot, and we will also review the intense margin squeeze facing Bitcoin miners, analyze exactly why their infrastructure makes them a perfect fit for AI data demands, look at the multi-billion-dollar deals driving their stock prices up, and evaluate the structural risk if the broader AI investment bubble bursts. To understand why this shift is happening, we must look at the hard operational math of mining. Following the April 2024 halving event, the reward for mining a block was cut in half. When combined with an expanding global network difficulty, the average production cost to mine a single Bitcoin shoot up significantly. By early 2026, the cash production cost for listed miners hovered nearly $80,000 per token, with some inefficient operators cost up to $101,000. Because Bitcoin's market price experienced a deep correction down to the mid-$60,000 range and even right now a low $60,000 range, it becomes a deeply unprofitable and triggering a massive wave of miner capitulation and rig shutdowns. The industry entered what analysts describe as a harshest margin environment of all time, forcing companies to find alternative source of revenue just to keep the lights on. This brings us to the core of the pivot. Many onlookers assume that miners are simply using their crypto computers to train AI models, but technically that is impossible. Bitcoin mining relies on specialized chips called ASICs, which are hard-coded to do only one thing: calculate crypto equations. They cannot read AI data. Instead, the pivot works because miners are selling everything around those chips: industrial land, massive cooling units, and most importantly, giant electrical power grid allocations. To understand this easily, imagine a popular restaurant area in a major city. Traditional data centers are like a chef who want to open a brand new restaurant. But the local city power grid takes 3 or 5 years just to approve the thick electrical wires needed to turn on the kitchen appliance. Crypto miners are like warehouse owners who already have massive industrial-grade power lines and water cooling system fully operational inside their building. AI companies do not care about the crypto mining inside. They are willing to pay an immense premium to lease the building and use those heavy-duty power lines so they can plug in their own high-end graphic card immediately. Because access to immediate electrical power is commanding a historic premium, companies executing these transitions are thriving. For example, infrastructure firm Core Scientific secured a massive 12-year, $3.5 billion contract with AI hyperscalers to host their computing system. Similarly, companies like Cipher Mining and Iron have seen their stock prices soar by several 100% as Wall Street asset managers value them as vital technology infrastructure firms rather than volatile crypto operations. While the transition is currently generating predictable multi-billion-dollar revenue streams, it carries substantial long-term financial risk. The entire strategy assumes that the massive demand for artificial intelligence infrastructure will remain permanent. However, macroeconomists are raising critical red flags regarding a massive mismatch between infrastructure spending and actual company profits. Wall Street institutions pointed out that global technology giants are spending hundreds of billions of dollars on AI data centers, but the entire cohort of pure-play AI software vendors is projected to generate less than $35 billion in total combined revenue this year. If tech hyperscalers realize that their expensive artificial intelligence tools are not producing enough organic customer revenue to justify the cost, they will abruptly cut back on their capital infrastructure expenditure. This pullback would be incredibly dangerous for pivoting miners. Converting an industrial crypto mine into an elite ultra-dense AI data centers requires an immense capital investment, costing between $5 million and $8 million per megawatt for advanced infrastructure overhauls. If the AI bubble bursts midway through these multi-year build-outs, miners could find themselves stuck with a massive debt and heavy conversion costs for data centers that no one wants to rent anymore. The pivot from Bitcoin mining to artificial intelligence infrastructure offer a brilliant case study on resource arbitrage. By utilizing their pre-existing grid allocations and industrial power assets, listed miners have managed to insulate themselves from the brutal profit squeeze happening on the blockchain ledger. While this dual compute strategy is delivering record-breaking revenues and strong stock performance right now, it links their financial survival to the long-term health of the generative AI market. If the underlying technology sector successfully handled its monetization challenges, these retrofitted data centers will form the backbone of modern computing. Thank you for watching this educational business update, and if you appreciate clean, objective market analysis free of emotional hype, please consider subscribing to the channel to support our work. Share your thoughts on crypto mining and AI pivot down in the comments below, and I will see you all in our next video.